My name is Paul Spirgel. I'm coming from forexfolio.com. We are going to be doing a webinar on the week ahead in Forex trading. We're going to endeavor to look at some of the data that's out for the week and try to make heads or tails of what that means for the currency pairs that we're going to be looking at. First off, we will try to get our legal out of the way with our disclaimer. Forex trading carries a high level of risk that maybe not first creates additional risk and loss exposure before you decide to trade foreign exchange. Carefully consider your investment objectives, experience level, and risk tolerance. You could lose some or all of your initial investment. Do not invest money that you cannot afford to lose. Educate yourself on the risks associated with foreign exchange trading, and seek advice from an independent financial or tax advisor if you have any questions. Any news, opinions, research, data, or other information contained within this presentation are provided as general market commentary and do not constitute investment advice. Forexfolio expressly disclaims any liability for any lost principal or profit without limitation which may arise directly or indirectly from the use or reliance on such information. Okay, that being out of the way, the focus of our week ahead is economic data. As you're aware, if you've been following the markets, we're in a bit of a downturn of the economics of global economies in a bit of a demise. We have European economies that are failing and trying to raise money to shore up their balance sheets. We have European banks that are in a relatively same boat. The last few years have depleted their resources, and they need to raise money to keep themselves within capital ratios. That being said, the global outlook is relatively bleak. Even here in the U.S., where we've had a bit of an upturn over the last couple of weeks, we still have banks that aren't lending as much as they should have, and the overall economic picture as regards to employment and housing is particularly bleak. We've recently made some headway in reducing the unemployment rate down to 8.4%, but we're still highly underemployed, and at the same time, our housing market is in particularly bad shape. That people can't refinance their homes, and there's just not available credit around for any particular growth. We've seen a lot of movement in equities here in the U.S., but a lot of that is companies are able to borrow better than the individuals, and they're really just borrowing and buying back their stock. But let's not get ahead of ourselves. First, we're going to be talking about some of the data coming out. What are we looking for when data comes out? What is the whole what's all the noise around the data? For some of you more experienced traders out there, data is a peek at the relative health of an economy. For instance, we're going to be getting an unemployment rate in Germany. As we know from here, the unemployment rates just measure how much employment is out there. The more people that are employed, the more people spend, the more profits go up, the more strength in the economy goes up, the more interest rates go up because there's more competition for funds. And that being said, the population has more wealth, they spend more money, everybody's borrow a line from trading places. You can go out and buy the G.I. Joe with the Kung Fu grip. Not to make light of the situation, but the more economic activity out there, the better it is for people all along the curve. From the lower levels of society all the way up top. The more spending that goes on, the more what they have velocity of money runs through the economy, the better homes you could buy. So what are we looking for? We've got the unemployment rate coming out tonight at 3:55 a.m. in Germany. As I said, there are no surprises in the economy now. The global economy is not in good shape. So for the most part, we're not really looking at the Germans to blow the doors off the market. As you can tell by the the chart I have up there, or the graphic I have up there, we're looking for a 6.8% unemployment rate. Generally, full employment is anywhere from 3 to 5%. 6.8% for Germany is not particularly strong, and it should be noted that Germany is actually the one place in Europe that has had relative strength. And as far as the pecking order in Europe goes, Germany is for that matter, even relative to the U.S., the Germans' economic machine continues to run at relatively full throttle. Where they're getting having problems is with the rest of Europe. The problem with Greece, as we know, is they spent too much and didn't have enough receipts to pay down or to pay back the creditors that they have. There's now ongoing negotiations where they're trying to refinance their debt, and ideally, the market was hoping that the Greeks could have had their renegotiation plan in place. There was the people who owned the Greek debt were going to take a significant haircut, and the people who are going to be refinancing their debt needed to take a significant haircut. Greek debt was going off anywhere from 14, 16, 18% a couple of months ago, and now the people who are going to be refinancing the debt are going to have to take a 70% bath on what they're expecting to be paid out. They're going to significantly draw out the terms of the term of the loan in order to pay that back, so they won't lose money over the long period of the loan, but they will have to wait a lot longer to get their money back. Well, that's all well and good, and it's very difficult for all the big hedge funds out there that have big positions in this. What does this have to do with us as medium-sized traders that are looking to take advantage of rates? Well, if they can't get it going, there really is what sent the euro, in particular, into a tailspin over the last couple of weeks. If you recall, we had gone down to 126.20, and the market was in really doomsday scenario. We were able to pull out of that because of some positive comments, and not some positive comments, but some not so negative news out of China. The Chinese are actually the future engine of growth, and while we were all bemoaning what was going on in Europe, there was some good news. The GDP in China a couple of weeks ago was not as bad as was expected, and that sent the market higher. Again, the market sees economic growth as a cure-all for all these problems. With the copious amount of debt that is out there overhanging the market, these countries are going to need to grow their way out. If we have tremendous amounts of debts on the balance sheets of countries, and they can't raise tax revenue by increased economic output and more profitability for their companies, we're going to be right back in the situation we were. And to this point, we were talking, I'm going to go to my next slide here, which, as important as the economic data is for our purposes since the beginning of the year and going forward, the European auction calendar is really what's going to move the markets down the road. Just getting a question in here. What if Greece gets EU procurator? Would that be good news for the economy? I'm assuming by EU procurator means that there's talk out there that the European Union would like to put in controls whereby if any particular country falls below certain criteria, the EU would come in and help manage their account. There was talk about this over the last couple of days. A Greek minister came out today and just cautioned everybody that the last time the Germans tried managing everybody else's finances, it didn't turn out too well to Europe. So would it be a good sign? It would probably be a good sign, but it would throw a lot of panic into Europe. I don't think, as much as everybody likes having the unified currency, there's still a tremendous amount of pride in the individual government's ability to maintain their own autonomy. So even as small as Greece is, and as bad a job as the Greeks have done at managing their finances, if we don't get a unanimous decision to allow that, the individual states are going to rebel against that, and the Greek population itself is not going to be too happy about that. As we saw when there was initial talks about this a couple of weeks ago, the English, who are not part of the European or the Euro, but are still part of the European market, they said they wanted no part of that, and they left the talks. So it's going to be a hard thing to sell, and you're going to need near unanimous agreement between all of the states to get that through. But that is one of the things they're working on. To get a calendar, you can go on Bloomberg from time to time. They will give you Bloomberg has upcoming issues of what's going on. I'm not sure if the FX Street people have one, but we will talk to them about getting one on there. If you look at the calendar I have on the sheet, on the screen, we've got significant amounts of auctions coming up this week. There's 33 billion euros worth of I'm sorry for keep saying but there's 33 billion euros worth of issue this week. And the ones that you really have to worry about are the Italian auctions, which went off today, and they went off relatively well. For the early part of trading, the bonds were sold at a pretty good rate. They backed up a little towards the end of the day, giving back 25 basis points on a 10-year. But all in all, it was a particularly smooth auction. The problem is, again, if you look, Italy's got some significant auctions in the 5 and 10-year space. You've got France, who's not necessarily a real offender in terms of overissuance, but they're coming through with a bunch of issuance this week. But the ones we're really key on throughout the week, and particularly for the first quarter, is the Italian and the Spanish issuance. The Germans are going to be able to sell as much as they want, and the French, for the most part, are going to sell as much as they want. But for the year, there was talk of $7.6 trillion worth of debt being refinanced this year. Of that, Japan has $3 trillion of it. The U.S. has $2.8 trillion of the debt. Italy is going to be looking to refinance $428 billion, the French $367 billion, and Germany $285 billion. This is refinancing. This is not new issuance, and as we know, along the way, some of these countries are probably going to want to add more debt on just to finance their way out of the doldrums that they're in now. So $7.6 trillion worth of debt is a serious overhang. Look at the same time, there's going to be corporate issuance that's coming along. A lot of companies are going to market with 30 and 40-year issues, and that's a tremendous crowding out effect. These governments, which at one point were paying particularly low interest rates, have been are going to have to compete severely with other corporate entities that are actually seen these days as a better credit. So at some point, if Microsoft comes to market with a 30-year issue and they're looking to pay 5%, the question is, who would you prefer to own as an investor? Microsoft 30 years or Italy for 30 years? And that's going to make things harder and harder when you take into account that going down the road, Germany and the European Union is going to have to borrow more money to bail out these countries. Again, going back to the Greek issue, the reason there was such importance about getting a Greek deal done as quickly as possible, we're talking about a $15 billion refinance of debt that the private investors have. In order to get, Greece has a $130 billion refinance that needs to be done in March. And if we can't get this 15 billion piece out of the way, then there's no way that they're going to be able to get the more important 130 million tranche. So it's, understandably in the scheme of things, this 130, 145 billion that we need for Greece is not. It sounds absurd to say it, but it's small potatoes in the scheme of things. But until we get that out of the way, the whole Europe is just waiting. And that being said, I'm going to try and do a nice little move here to get up a chart of the euro. And just confirm to me if I have a euro 1 hour chart there. All right, so you should be looking at a picture of a 1 hour euro chart, and this is going back for a week here. And as you'll notice, we've had some good movement up, and the original movement up here was based on the as I said, the Chinese GDP numbers, which, not that they were good, weren't as bad as they were expected, and the market took that as a signal that if China's starting to show some economic movement, then Germany will, and then the rest of the world will. What we've had here now, and again, part of the reason why we're doing this on a Monday night instead of a Sunday night is it's always a good idea to get a trading day under your belt so you could understand where the different patterns and ranges are. We saw last night and over the weekend that the high for the euro was 132.50. So with as much news as we've had out and nothing new coming out, we know fundamentally and technically at this point that the high for the most recent range is 132.25-ish. We also know since Friday, 130.80 has been the recent low. We put it in this morning, and we put it in last Friday as well. And technically, we're looking for that. And I've drawn a nice little trend line here that shows this area right here as that 130.80 area. Should we get the bounce through there, we could expect that the euro to come back and fill this most recent gap, and probably have a move down to 129.25. So all things being equal, if we were looking to take advantage of some of the ranges here, you'd probably want to be a buyer between 130.80 and 131 the figure, and with a stop loss below that 130.70 area. And again, on the upside, we can get above 131.70.80, a buy there. We'd look for exhaustion at the 132.25 area and probably look to trail a stop along the way once we got above 132 the figure, hoping that we'll get through that 132.25.30 area. But if not, at least we're protected if the market goes lower. Again, getting back to the ethos of what this webinar is supposed to be, the week ahead. What are we looking for on the week ahead? And that being said, what are the we know fundamentally at this point what the levels are. We've got euro 132.25, 130.80 is the range. Again, depending where we are when some of these auctions come out and when some of the news headlines come out, we're looking at playing against those ranges there. I'm going to get up hopefully a dollar-yen chart. Okay, there we go. What you're looking at now is a 15-minute dollar-yen chart. What we're seeing here is the risk-off trade is what's back on. Again, we saw a nice move lower in the euro USD, and that's being confirmed here in the fact that dollar-yen, which has been a safe haven play lately, has been going much lower. You can see it. We had a move up last week that we had gone all the way up to 78.20. Again, there was this false optimism that we were going to be looking at, greater opportunity, greater economic recovery, but that has not panned out. And again, part of the Greek thing dragging on as well. I just showed this again. If you give me one sec, I'm going to confirm what you're seeing. We've got here's the Euro-Swiss chart as well. There's been a great move in the last couple of days for safety, and the Euro-Swiss and Dollar-Swiss for that matter has been a great safe haven historically, and in the recent crises, Swiss and yen have been the two great safe havens. We've had backups in both. We're on significant levels in both. In the Swiss, we know that the Swiss National Bank is sitting at 120. They've commented frequently that 120 is the level that they think they need to defend. There are macroeconomic reasons for this defense scenario. The Swiss corporations are losing the ability to compete globally for their services, and the Swiss National Bank, as the custodian of the greater economy in Switzerland, has decided that 120 is the level that they're going to defend. That being said, if some of the external stimuli that are going on in the global economy are so great that the world just keeps pouring into Switzerland as a safe haven, the Swiss National Bank is going to lose that fight. We have the same problem going on in Japan as well. The Japanese have made it known that 75 to 75.5 in dollar yen is a particular area of interest that the BOJ is looking to defend. Now, what we have now is almost a perfect storm. And give me 1 second here, and I will try and get up a chart. This is, one moment please. This is the Euro-Swiss chart. And again, I apologize, I'm working off of one screen here. And you can see it's been a nice straight line down that the Swiss have been, since this is last month when they did not move the band up to a 125, the market took that as a signal to start an assault on 120. And they've been slowly ratcheting it lower, and it feels like, unless the Swiss come out in the next 20, 30 pips, that the market is going to take a good run at 120 and force the hand of the Swiss. At the same time, we were saying in dollar yen, 75.5, 76, and Euro Swiss as well. Excuse me, I'm getting ahead of myself here. The Euro Swiss and the Euro yen and the dollar yen are all converging on areas that the various central banks have said are areas that they would like to not like to intervene, but they would be willing to intervene. So if in fact the Euro Swiss goes to 120 and the dollar yen, which is now at 76.20, goes down to that 75.5 area, there could be some significant forces out there in terms of central bank interventions in just buying dollars everywhere. So it would seem like a prudent area to keep some defensive stop dollar purchases in your market. I would say, particularly in dollar yen, we've seen 78.20 is the last area of resistance. I like to think that when the central banks have come in the last few times in dollar yen, they've gotten anywhere from 150 to 250 points of movement out of the interventions. So if we're trading at 76.20 now, I would leave a defensive stop anywhere from 77.20 to, 1 second here, anywhere from 77.20 to 78.20. Again, looking for that blast above to take us even to 79.40, which was where the last intervention petered out, to come all the way back down. That conclude some of the slides here. If anybody has any questions, I would be happy to take them and answer them. Again, I apologize for some of the spotty film work that I've done, but my first time, and I'm hoping I'll do a little bit better as we go along. I think gold is going back to record highs again. I've had this discussion in the past, and I believe that for now we've had a significant move in gold higher. For the beginning of the year, we've seen the market put on gold trades that had taken off last year. Again, as technical as everything gets, the market is populated by people, and it's populated by people who make money by managing money. The gold trade at the end of last year probably got sold off in as much because people had profits in it and they wanted to take that at the end of the year. At the beginning of the new year, again, as we discussed, with the significant debt refinancing that's going to happen, there's a need for some safe haven, and there was a need to put back those trades on that people had sold off. When we had moved through 1600, and again, forgive me, I'm going to try and get a chart of gold up here if I botch it. All right, now you should have a gold chart up, nothing too fancy, just regular. Now what we had here, again, at the end of last year, we had broken through support at 1600, and it's gone down. And again, this was all part of a greater decline that came also from about 1750 or so. We'd meandered lower towards the end of the year. Again, every time we had tried going up a little bit, and then for the beginning of the year, we had moved higher. We've reestablished 1600 as support, and clearly we had gone sideways throughout much of the year, and then here we are last week at the liquidity event that Mr. Volcker, I'm dating myself there, Mr. Bernanke threw out there, saying that we're not going to have interest rates go any lower anytime soon. That's actually exceeding, as positive as it is for the rest of the market, and we know from 2008 that the market here loves liquidity, especially free liquidity and liquidity that there's no risk knowing about. Gold in particular, which doesn't pay much of an interest rate, loves that because there's really no downside. If you were going to buy a bond, at 5% or whole gold would pay you hardly anything, basis points, 25 basis points. But now that bond rates are going down to 1.5%, 2%, 2.5%, and the gold rates are at a quarter, the differential between the two rates just makes it that much easier to own gold. There's no real currency risk in it. It's just a static metal, and you're not giving up anything on the interest rate side. So as long as interest rates stay low, the incentive to own gold is going to be there. And again, for now, 1700 is going to be our good support area. We've ratcheted it up. If behind that, really 1675, and we had at Forex Folio were saying all along we had expected 1600 to hold. Then it was 1640, 1675, and now that we've blown through that, unless we have a significant event that would cause people to sell their gold positions to raise capital, I see no reason for gold not to continue its move higher, and possibly towards the end of the year to put on new highs, cracking 2100 even. One more sec. Another thing we've been looking at is the Aussie Canada, and you should have a picture of that coming up on your screen momentarily. We don't have this particular data out this week, but it is on the horizon. Aussie rate announcement coming out on the 6th of February. We're expecting, again, that the global economic picture not being as robust as people would like it to be is going to stir the RBA to cut rates. Now, we think that's going to have particularly deleterious or negative effect on the Aussie-Canada pair. Aussie and Canada are two very similar economies in that their population, their commodity makeup, their their internal metrics in terms of how much debt they have outstanding and the type of government that they run, the hedge book that they run in terms of they don't have increasing deficits and they're small enough to manage their own money. The Aussies cutting rates should weigh heavily against the Canada in particular. The Canadians are actually they share in with the perceived growth that we're seeing here in the U.S., so they're not looking to cut rates anytime soon. In fact, in the last Canadian rate decision, they did nothing. They held pat. We're of the opinion that if the Australians cut rates, we're going to see some movement in the Aussie CAD. We've been trading around here in a range 105.80 to 106.80. We had moved up from 105.20 through that range with the euro euphoria that we've seen the last week. The Aussies shared in that. We would think that if we can get a move through 105.80 lower, we would take advantage of that ahead of the RBA meeting. Aside from that, if we get up in the high 106s, as we did a little bit last week, again knowing that there are some good offers in the euro at 132.25, and there's some good offers at 106. In the mid 106s in the straight Aussie, we'd expect that cross would come a bit lower. Again, just trying to take advantage of some of the interest rate differential between the Australian and the Canada. And that's a little bit of that. Again, getting a question why I say Monday is better than Sunday for a webinar. Well, there's always going to be opportunities, but the reason that Sunday is, or I'm not a huge fan of putting on the bigger positions on Sunday, is that I'd like to see a full European session before we start making some judgments. I mean, right now we've seen a nice move in the euro in particular from, again, 132.20 down to 130.80, and now we're sitting pretty much in the middle of that. Really, it's just an opportunity to see the way things are going. You know, again, the reason for this is, you know, looking ahead, and looking at the week ahead, we're trying to gauge what the market sentiment is. Technicals are great, but if you don't know what the sentiment is, where those, you know, it's almost tactile where the feel is, why, you know, it gets up to a certain level and it's offered, you know, why is that? You know, you can't really get that on a Sunday night. You know, I've worked at a couple of firms that, you know, Sundays were used solely to put positions on that were taken off over the weekend. You know, especially in these tumultuous times, a lot of firms will take a portion of their positions off over the weekend and put them back on Sunday. For the simple reason that, you know, if some news comes out on Saturday, they just see that as a random event, and they're not looking to get, you know, stopped out because of a random event. So there's a lot of just position jockeying that goes on a Sunday night and into the European Open that could be construed as noise for the rest of the market. So for our purposes, I'm assuming most of the traders out there are similar to me, that they'd like to be a touch more surgical with their entries. You know, it's just a good idea to see, you know, where the ranges are going to be settling out, and just finding how the market's going to react to different types of news that's out in that first day of trading. It never hurts to glean a little more market knowledge, you know, reading between the lines. Anyone else? Okay, I'm getting a question: how well are the Italian bond issuances being received, and do I believe the ECB can support these issuances? Well, with the Italian bond issuances are doing much better than they were in November. Italian and Spanish 10-year yields are down anywhere from 75 to 100 basis points, 75 for Spanish and 100 for the Italian since the November doldrums. Even since last week, the Spanish yields dropped about 20 basis points and the Italian 15 basis points. There's a movement afoot to bail them out. The U.S. actually is doing more of the lifting. The announcement last week is more than the Europeans have done, and that's it's really, if you think about it, it's the makeup of the different economies. The Europeans are on maybe not necessarily the euro specific, but Europe in general is an amalgam of 27 different markets. And for them to get anything done in a meaningful way, you need a majority of 27 markets. Here in the U.S., when we cut rates, it was one guy saying we're cutting rates for the whole country, and there's no, there's a benefit in how quickly the U.S. acted. Whether you agree with what they did, the bailout, and how they did the bailout or not, it was swift at least, and that builds confidence. What's going on in Europe now with the back and forth, the Germans don't want to go in, all in, and they're looking to get backhand control, and the rest of the Europeans don't trust them just because of the history, even though it's not particularly relevant now. I don't think, at some point you need leadership, and the leadership in Europe right now are the Germans, the British, and the French. The French were downgraded, and what we need is Merkel to come out and say we're going to do what it takes. We were talking about some of the fiscal union that we were mentioning. The British left the table when they were talking about some supranational entity taking charge of individual economies. So I think they have a good chance. They're keeping rates low, but then what? So you refinance this whole mess. How much? To a certain degree, low interest rates will put us in this problem in the first place. At some point, somebody's going to have to take their medicine. It's not going to be it's not going to be good for a while. It's a lot of money. We're throwing around billions here, and trillions. It's significant. Do I still think Greece will be in the euro in the next few months? There was actually an article on Reuters earlier that at the World Economic Meetings in Davos the other day, there was a dinner for the outgoing SNB president, Philippe Hildebrand. He's the guy whose wife was doing some dollar trading when the Swiss originally moved the floor to 120, but that aside, at this dinner, apparently they passed out slips asking the different heads of different economies. There are people from North America, Europe, Latin America, Asia, all finance ministers, and they were asking them what they thought the makeup of the euro will be in 5 years. And significantly, they said 21% of the attendees said that they saw the potential for a breakup of the euro, and 35% said that if the euro did survive, it wouldn't be in the same style that it is now. There's been talk of the euro almost being like a soccer table, or the soccer leagues in Europe, that you could relegate some of the weaker countries to a lower status. So it's not. Do I think it'll be around? I think it'll be around because I think breaking it apart at this point will be much too difficult. There's just too much interdependence. But some of these people who know a lot more about the internal machinations of finance in Europe think 21% are voting for the possibility of a breakup, and 35% say there will be some kind of change. So it's not a stupid question. There is significant talk about that. Good question. Anybody else? With regard to Eurozone debt options, what are you watching? Price, yield, spread. Well, Mr. Volcker chimes in with what are we looking for in European sovereign debt options? We're looking really just for rate. The ability to refinance is really just the rate. The 10-year in the Bund in Germany, it trades at around 2.7%. The 10-year in Italy was trading at 7 and change a couple of months ago. So that if you get that big blowout number, when auctions are well received, that means interest rates come out on the low end of the expectation. If interest rates start backing up, that means not only did that auction fail, but future auctions are not going to go off as well. And again, we're inside of the first month of a 12-month cycle where we're saying just in the big three of Europe alone, there's in excess of $1 trillion worth of debt to go off. So there's a long way to go, and if those rates don't come down, big deal. If you could refinance at any rate, you're still going to wind up paying a ridiculous amount along the way. At some point, you may just be better off defaulting, especially when you have that much to do. So, a currency, the bond yields, those are all very significant harbingers of what how well your country is run. And again, notwithstanding the U.S., I mean, we may not be the best place in the world these days, but we do get in front of our problems as quick as possible, which is a luxury that the Europeans don't have now. So keep an eye on the rates, and they'll tell you'll see it by movement in the euro. If the auctions aren't going well, you'll see it get downgraded in a hurry by the market, at least. That's it on that. Anybody else? Somebody was asking by what I meant by relegate them. By relegate them, there was talk of just it would almost be you'd be out of the euro, or be a junior member of the euro. It wasn't really clear what they were doing, but almost like a forced kick out. At this point, you need a unanimous vote to throw somebody out of the euro. But the French and the Germans were looking. The French and the Germans were looking to have the ability to throw somebody out unilaterally. And again, when you have 27 people, 27 countries that are involved in running the whole show, it's going to be hard to get that passed. But something needs to be done whereby the weaker people have to be able to be made to stay in line. That's it. If there's nothing else, I'll give you a little story. You've heard me go on here. Let me tell you a little bit about who we are. 1 second here. All right. Forexfolio is a team of industry professionals leveraging decades of combined Forex experience and dedicated to helping our customers meet their financial goals in the Forex marketplace. We've got a pretty significant team that have worked at several different online firms out there. We've managed trading, we've managed sales departments, we've done customer service. We're looking to add value in any way we can to any of our potential customers. We provide our customers, both retail and institutional, with exceptional service, superior products, cutting-edge trading technologies, while pledging transparency, openness, and honesty to help you meet your financial goals. Some of the products we have out are trading signals. We have a signal service where we send our trade ideas via SMS and text message at least daily. And if there are any extra events out there that need clarification or any news blasts out there that we feel our customers need to be kept abreast of, we will send an SMS and an email about. We've run a live trading room. We've since moved that to 8:30, but depending on how much need there is, we've been doing it at 8:30 recently, so we can take advantage of some of the economic data out there and discuss it. But that is not set in stone yet. What we do there is very similar to what we do here. We have our trades that we're looking at. We discuss them. We look at what the market's doing, the impact of some of the data, on a relative real-time basis. As the data's coming out, we'll let the market run its course, and we'll see what opportunities open up from there. It's a good give and take where people are given the opportunity to to educate us as much as we educate them. We have a service that we run virtual desktops. If you can't be at your computer all day, we have relationships out there with server farms that'll run EAs for you. We have our own EAs that we excuse me that we have developed that have had some interesting successes that we'd be happy to discuss with you. We work with most of the major firms out there: Alpari, FXDD, FXCM, Forex.com. If there's a particular broker you need to look at that we don't talk to, we almost certainly have a relationship with them. Most importantly, how can you contact us? Any questions, comments, suggestions? We would look forward to hearing from you. You could send a email to me, paul.spirgel@forexfolio.com. We have a dedicated email for our trading signals @forexfolio.com. Please visit our website, forexfolio.com. Anything we can do to help you, anything that's not on our website, feel free to send us an email. Any help you might need, any problems with a particular broker, we are there to help our customers with anything they need. That's pretty much it. Again, any queries, please drop us a line or look us up on the internet. Keep well, and thank you for attending. And I hope I added a little something there for you, and I appreciate all the feedback.